There's an account most young healthy people are ignoring because its name makes it sound like it's for sick people. It has a better tax structure than your Roth IRA. And this year more people qualify for it than ever before. Health, savings, account, HSA. That name is terrible. Health implies the account is for spending on health, which implies you're sick, injured, or managing something. Young healthy people hear it and file it under not relevant to me right now. That filing is wrong and it's costing you. The HSA is not a medical expense jar. It's a tax-advantaged investment account that happens to have a medical expense carve-out. Almost nobody frames it that way, and that distinction is the whole ballgame. No other account in the American financial system does all three of these things all at once. Contributions go in pre-tax. You don't pay income tax on money you put in. And if you contribute through payroll, you avoid Social Security and Medicare tax, which the Roth IRA does not do. The money also grows tax-free, invested in index funds inside the account, and the gains are never taxed. Withdrawals for qualified medical expenses come out tax-free. No tax going in, no tax on growth, no tax coming out. The Roth IRA gets 2 of these 3. Your 401k gets 2 of these 3. Your HSA gets all 3. Nothing else in the American tax code gets that. One gating requirement. You do have to be enrolled in a qualifying high deductible health plan. You cannot be on Medicare. But as of January 2026, eligibility expanded significantly. Bronze and catastrophic ACA plans now qualify, which opens the account to millions of people who previously could not access it. If you checked this a few years ago and figured you didn't qualify, it's worth checking again under the new rules. Now, the objection that kills this account for most young people. I'm healthy. I won't use this money. It just sits there. 2 things. After 65, the HSA converts to a traditional IRA. You can withdraw for any reason, not just medical expense, and you simply pay income tax on it. The money is not locked away forever for healthcare spending. It is a retirement account with a medical expense bonus while you're building it. If you never spend $1 of it on healthcare, you will still end up with a fully functional retirement account that benefited from triple tax treatment the entire time it was growing. The second piece is less well known and completely changes the math for young people. There's no time limit on HSA reimbursements. You can pay medical expenses out of pocket today, save the receipts, invest the HSA money, let it compound for 20 or 30 years, and reimburse yourself tax-free later. That $2,000 dental bill you paid out of pocket at 32, as long as you keep the receipt, becomes a $2,000 tax-free withdrawal at 55. And that $2,000 that stayed invested compounded significantly by then. We'll do a full breakdown of this receipt strategy in a separate video because it deserves more than a passing mention. The short version. Every medical expense you pay out of pocket and document is a future tax-free withdrawal sitting in a shoebox. Young healthy people are positioned to win this game more than anyone because they have the most time. One note, if you're working with a tighter budget, you don't have to contribute the maximum to make this worth having. Even small irregular contributions still benefit from the triple tax structure. Start with what you can. The account doesn't require a commitment to perfection. It just requires existing. To add to the mathematical advantages, spending HSA money has some interesting psychological and behavioral properties. When I pay a medical bill with HSA money, it produces a specific feeling, like getting away with something. Tax-free money taken out of an account that grew without taxes from contributions that went in pre-tax. The transaction feels completely different than paying out of pocket. It feels like house money. And that feeling has a practical consequence that goes beyond the tax math. When medical spending feels like it comes from a separate account that doesn't deplete your real resources, you make different decisions about your health. The physical you've been putting off, the specialist referral you've been ignoring, the dental work, the therapy session, the things that genuinely matter for your well-being that you skip because they feel expensive against a regular budget. Mental accounting usually works against good financial behavior. It's the reason people treat a $500 tax refund different than $500 of regular income, even though it's the same money. But in this case, mental accounting works for you. The HSA creates a permission structure for spending on your health. And spending on your health is probably one of the highest return investments that you will make in your entire life. It just doesn't show up on a brokerage statement. The account sounds like it's for sick people. It's actually for anyone who wants the most tax-advantaged place to put money that exists in the American financial system, with a built-in permission structure for taking care of themselves along the way. If you've already got your 401k match and your Roth IRA sorted, the HSA is the next stop on the priority stack. We covered that full order in a previous video if you want to work through it. As for the HSA, check if you qualify under the new 2026 rules. If you do, open one.